Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and I have Adam Sarhan on the line. He's a founder and CEO of Sarhan Capital. How you doing this morning, Adam?
Oh, we're doing excellent.
All right. Let's just first, before we go into individual tickers here, you've been a pretty staunch bull in the market. A little bit of weakness yesterday. Market's been flirting around the 2100 level. Give us your take on the S&Ps, the broad market.
Sure. It's always important to put the last move in the proper perspective. So what does that mean? In the last 3.5 weeks, the S&P 500 rallied just about 7%. From the 1980 low hit on the 2nd of February up until the 2119 high, interestingly enough, hit on the 24th of February. So from the absolute low in February to the absolute high, the S&P rallied about 7%. Now, in historic normal days, by I mean normal non-QE/EV money days, a 10% rally for the entire year was considered good. So you had 7% in 3.5 weeks. The markets earned the right to pause and digest that gain, and that's exactly what we're seeing happen right now.
I never put things in that perspective. That's very interesting here. So nothing to worry about long term, just a little bit of healthy pullback, maybe get to buy some things on the cheap. Want to move into crude?
Yeah, I mean, also a few other points too, Joel, just to make sure that the listeners and the audience properly understand my view. My thought process is that the market right now, there's nothing to worry about. But if the market does roll over and we start seeing some material weakness develop, then that's going to change the tune. But right now, we haven't seen a 10% pullback since 2012. That's about 3 years ago. That's the first thing. So all pullbacks, by definition, have been shallow in both size and scope. So what does that mean? Size is single-digit percent declines, which is perfectly normal, and then scope, the pullbacks don't last very long, and that's a very strong sign that the bulls are still in control of this market.
Okay, let's take a look at the crude oil market. Now, I know you for a while you've been short, and I'm not sure if they've shaken you out of that short yet. A lot of diving and dipping around the $50 level. Give us your short and long-term outlook for crude.
Yeah, I mean, you guys had a great show last week all about crude, and it was great to listen. Basically, the crude oil trade, we were short for the end of middle of 2014. We began probably the short side, but we were on your show, I believe, right around $90, and said, "Listen, it's a short. It's going lower. ... It fell all the way down to the low 40s, and then since it's bounced and spent the last maybe 2.5, 3 months consolidating that sharp decline. So typically whenever a market moves, you see a big move, up or down, and then you see it move sideways and build a new base to consolidate that run. So what happened with crude is you saw a very, very sharp, steep decline in a very short amount of time, basically from 107 all the way down to 43. And then at the end of December/early January, the market just stopped going down. Then you notice something changed. So all of a sudden, it's not just a free fall like it was for many, many months. So the last really 2.5 months here, you've moved sideways right around that $50 area, which is perfectly normal. Volatility is compressed, which is also healthy. And then now it's giving the market a chance to digest that steep decline. This is one of the situations where one of my trading rules is the next move wins. And what does that mean? Either it breaks out above resistance of this little base and it tries to retrace and go higher, or it breaks down below support and then it resumes its broader downtrend. But by definition, the market's moving sideways right now, and really it's chop city. If anyone's trying to take a position, it's not going anywhere until it breaks either above resistance or below support.
Okay, let's go to some individual tickers that you're following now. Apple, a couple days in consolidation here. We did make the all-time high at 133.60. Posted the all-time high close the next day at 133. But I'm chomping at the bit here. I'm looking at this 128 level here. 3 lows within a 20-30 cent range. Not really reacting to the negative, to the SPOOs being down 6.5, probably trading ahead of full value, fair value. What's your take on Apple?
My take is the stock is still attractive, intermediate and long term, probably headed higher. The company continues to innovate. They remain a leader in its space. So if you look at the market, the economy, the market share, the brand equity, all the intangibles, you check every box. Company's still growing earnings. We saw last quarter blowout earnings. So, I mean, you've got the growth. Apple's what I call an undervalued growth stock. The PE ratio is still attractive. The company has tremendous growth quarter after quarter, sales and earnings, and all the fundamental metrics. You check every single box. So this is appealing for the value investors. It's also appealing for the growth investors. So it's in a sweet spot right now. And I think the stock in the short term is a little extended. I mean, look where the 50-day moving average is, or look where the 200 is. And normally the stock pulls back into the 50, then bounces and goes higher. It pulls back into the 150 or the 200, bounces and goes higher. You have had a big move in the last few weeks here. So it's earned the right, just like the S&P, to pause and digest that rally.
Do you have any historical perspective on how it reacts, going into big events, whether it's had a run up and then a pullback? I know there was some wild trading action when they announced the iWatch and the iPay. Any kind of take on that?
Yeah, typically Apple's notorious for their secrecy, and they manage expectations better than any other company out there, and they've been doing it for a decade. So what they do quarter after quarter is they blow out numbers typically, and then they lower guidance, and the stock tends to fall unless if it's a monster quarter. And everyone's curious, like, why? They don't understand why is the stock falling after reporting a very strong quarter. The reason why is because they tend to lower guidance. The reason why, and then the next quarter they just blow away estimates again. The reason why they do that is because if they don't continue to underpromise and overdeliver, they've got lofty expectations, both from analysts and consumers. The bar is very, very high for Apple. Now, if they don't lower expectations and play that expectation game with the public and both Wall Street and Main Street, then they're in trouble. So they understand that very, very well, and they've understood that for a decade. So whenever they have these big events, there's a lot of excitement pent up. There's a lot of, people want to know what's going to happen. Believe me, use an iPhone, use an iPad, the iWatch. You come out here with one of these big devices that revolutionizes the way people live their lives. I mean, that's why the stock has had such a phenomenal run. iTunes, the cell phone, the tablet, ... So that's why there's such pent-up demand there. But with respect to the actual stock, it really depends on how the consumer, how the market reacts to the actual news event. So if they come out with a flop or a dud, which they did for a while at the end of 12 and early 13, they just weren't innovating before that iPhone 6 came out. There was a period where they just had these events, and it was nothing really fun. I mean, they did a 5S with colors, and everyone's like, come on, guys, get with the program, make a bigger phone. So it all depends on what the actual event is and then what the actual products are that are announced.
All right, Adam, we are going to go rapid fire here with some stocks that are trending, and we're getting some debate. Get some debates here in our chat room. Ambarella Inc. Beats the street. This thing is off to the races, trading near the highs of the pre-market session, right at the highs, in fact, trading at 68.43 high, trading at 68.29. They got the boost that, kind of expected. The makers for equipment and GoPro. What's your take on this issue?
It's interesting because if you look at GoPro stock is going down, these guys are still going up. They're actually not just a GoPro-only story. I'm very bullish on the stock. They are tremendously positioned as far as a technology component to not just GoPro but other players in the industry, and they have an innovative product that's in demand. More importantly, the stock technically looks great. You have what's called a breakaway gap today, where if the stock does open higher, it's going to literally break out of its range and hit that 68 level and off to the races. Those breakaway gaps where you wake up one day and there's literally a gap in the chart from the prior day's close are typically very bullish, and it tends to lead to a lot more buying because those are the big institutions clamoring to buy the stock.
Okay, so looking through follow-through from the pre-market trading. OReX, big move yesterday. Biotech, I believe here, therapeutics. What else do you need to say? How do you is this one that you follow?
Yeah, this is one that I follow. I mean, I follow the space. The IBB is the ETF for the entire biotech, but specifically OReX. Here's a situation that's kind of percolating. It reminds me somewhat similar to the dot-coms in the late 90s and March of 2000. Interestingly enough, on Monday, the NASDAQ topped 5,000, the highest level since in 15 years. But the biotech space in general tends to be an area that I watch closely. And the manufacture of these drugs, it's almost like there's a lot of froth that is starting to come into the market. So I watch the space closely. I'm bullish on the space, but I'm a little bit cautious because I do feel it's got some tendencies that are a little bit ahead of itself.
Little
Because I've seen biotechs that are very thinly traded. They have no sales, they have no earnings, but stocks just soar, and that's typically not a healthy sign.
Okay, let's just take a look at another stock here. Food stock, Kroger. I'm not sure if we got. I know they had earnings. I don't know if they're today or they're already out or after the close here. A little bit of a sell-off coming off all-time highs. What you take on Kroger, KR?
The space itself has been very bullish. You've seen a lot of consolidation. Winn-Dixie's more or less gone. The supermarket space we've been bullish on for a while. The stock has had a phenomenal move for the last few years, and right now you're actually sitting, I think, a few percentage points off all-time record highs. So the stock has earned the right to pull back and digest its move a little bit. I want to see how the stock acts over the next few weeks into the moving averages. I'd look at somewhere in the area of the $68 area and then the $56 area for the 50-day moving average and the 200-day moving average. But in general, the stock's had a huge move. It's got to pause a little bit, digest that move, look to buy after the dip. So once the stock dips a little bit, it'll start bouncing again. That's when I would suggest people to get back in if the story hasn't changed.
Abercrombie.
That's how I buy dips.
Yep. Okay. Good approach there, especially with earnings coming out tomorrow. Abercrombie and Fitch here, taking it on the chin here in pre-market trading. Disappoints the street. Way below the Ebola lows, way below the low of the move here. Trading on the lows of the pre-market session of 21.92, currently trading 22.03 with good volume associated with this. What's your take on ANF?
Sure. ANF is actually in a bear market. So I'm bearish on the stock. I have no, I do not recommend people jump in there right now and buy it. They're in a very, very tough space. And what do I mean by bear market? Typically, the definition is a 20% decline from a recent high. Well, back in August, the stock was trading at $45. It's now at 23, so it almost got cut in half. So you're in a situation here where you're way past the 20% decline mark. So even though the stock market's in a bull market, there are areas that are extremely weak. And this retailing space, specifically ANF, is a very, very weak stock. And the relative strength is awful. So whenever you see a stock that can't move higher in a bull market, typically that's a bad sign. But when you see a stock get basically decimated, like what happened here with ANF, there's a lot more concerns out there, and large investors are not buying the stock. So I would not touch this at this point in time.
Interesting chart in the CME group here, where they trade majority of the futures products. Double top on the daily at 97.18. Backed off all-time high close 97.12, 97.10. Last two closes. Boy, this thing looking itchy for a breakout, huh?
Yeah, I think so. And the double top, I understand where people could look at this and say it's a double top. I have a little bit different take on it. I would look at a monthly chart or even a quarterly chart and say, you know what, this stock looks great. You had a big base breakout a few months ago, and then it's basing now to consolidate that move. It looks like it wants to head higher. Remember, the old chart highs back in, interestingly enough, December of 2007, the high was 142.90. Right now, the stock's at $97. That's a big move just to get back to even. So look at the NASDAQ, how it went all the way down. Now it's working on the right side to get back to its March 2000 high. This thing hasn't even gotten back to its recent 2007 high. So if the stock does break out of this little range here and does go higher, you're in a situation where you can have a lot of appreciation just to get back to even, and then even more. So the entire space, I mean, look at ICE futures, look at some of the brokerage stocks. As the stock market continues to recover, the economy is improving, rates are at zero, the easy money is pumping from central banks. A lot of these exchanges and brokerage firms are acting very, very well.
The SIBO, I know that one. I know it had a miss a little while back, but looks like that's recovered as well. So looking at the exchange space, just a couple more tickers here where we kind of have a broad question for you. Pay, Vodafone, any take on that?
Yeah. Pay is a very interesting stock. We've been watching it for many, many years. I remember when it had a huge move back in the 2000s. Pay is a situation here where you had a big move, and then you fell off hard in 13. Interestingly enough, it kind of looked like ANF, where the market was going higher in 13, but the stock was just going straight down. and then it bottomed right around July of 13. And since that bottom, or even June, you can go back and say it was right around $15. Now it's at 35. You had a huge rally off those lows. They basically had some trouble. They were able to get their act together, and the stock has recovered handsomely off those lows, but it's still way below its high from 2012, and then its high from even further back in 11. So I'm of the mindset that there's a lot of the consumers, the global consumer, is moving a lot more towards this Apple Pay or this concept of, hey, I want the simplicity, on demand. I just want to pay right now, really easy. And these guys, Verifone, they're in that space, and they're a leader in that space. They need to innovate. Just like Apple at the end of 2012, how they went nowhere for a long time before the iPhone 6 came out and the stock was dead, the same thing here with Pay. And the second they come out with something that's simple and simplifies the experience, and it's ubiquitous, it works everywhere, Android, Apple, ... the stock's going to take off.
Looking for a catalyst. Broad question here from Rob Hood. Market near all-time highs here, but what areas of the market do you see as like the next great opportunity? Kind of a broad question there, but you have emerging sectors, cloud security. Where are you looking for the next great opportunity?
Sure, I would say the social media stocks look great, specifically Facebook, LinkedIn, Twitter. The ETF for social media is SOCL. It's a little thinner, but it's still a widely traded ETF. And that space literally did not exist 15 years ago when the NASDAQ was at its all-time high. And now it's a big portion of the NASDAQ. So as that space continues to grow and improve and innovate, look at LinkedIn, for example. They are such a powerful company. And by the way, we have positions in many of these stocks, just for full disclosure. But LinkedIn is such a powerful company that they're able to monetize not just their advertisers. Hey, you want to reach these demographics? Sure, no problem, advertise with us. But they can also monetize their users. Hey, you want to network? You want to be a recruiter? You want to get hired? You want to reach out and send emails to people and expand your business network? Because it's such a powerful network, and because it's business, it's not just a social thing. It's also a business media. Instead of social media, it should be business media, or some kind of sharing to the business world. LinkedIn can monetize it from both sides. From the users can pay to be premium, and also the advertisers want to reach those users. So they're in a really, really strong position to grow.
Okay.
Also, I like housing and financial.
Okay, you got it. You still got some areas of value that you're looking for. Adam Sarhan, founder and CEO of Sarhan Capital, touching on a lot of different sectors, commodities, the broad market. Thanks a lot, Adam. We hope to have you on again soon.
My pleasure. Thank you.